Hello, my name is Dot, and this is Group 1. Our group is going to present about the financial analysis of having a construction company and we use Cotacoms as the comparison. In this presentation, our group will refer Haben as HBC and Cotacoms as CDD. So this is our group's agenda. The company's full name is Haben Construction Group Joint Stock Company. The firm is operating in the construction industry, providing customers with services related to general contractor and design. Below is some detailed information about this firm. Haben Construction Office was founded in 1987 and in 2000 it changed its name into Haben Construction and Real Estate Joint Stock Company. In 2017, in its 30th anniversary, the firm changed its name into Haben Construction Group Joint Stock Company. In 2021, Haben become the largest contractor in Vietnam with a market capitalization up to over 5,000 billion Vietnam dong. BDO was Haben's first audit firm in 2010. However, the company worked with Ernst & Young since 2011. The Ho Chi Minh City Stock Exchange lists Haben share on the stock exchange code HBC in 2006. This is the first construction company in the South to list on the Vietnamese Stock Exchange. The number of members on the board of directors range from 5 to 11, and the total number of independent members must account for at least 1/3 of the total number of members. Currently, the firm is managed by an 8-person board of directors. These 3 people are the chairman, CEO, and the deputy CEO, respectively. Mr. Le Viet Hai is the largest stockholder of HBC, owning 60.05% of the company stock. And the information below shown the other 3 largest stockholders, the ratio, and the number of shares. The following is a list of the firm's 4 majority-owned subsidiaries, together with information on their ownership rate and authorized capital. Next, my teammate will present about the analysis of profits or loss and balance sheet.
Okay, thank you, Thục Đoan. And next, we will talk about the balance sheet of the HBC. First, I will generally analyze the key terms in a given balance sheet table. In the period up to 2018 to 2019, the figure of total assets and owner equity witnessed a positive trend for investors. To be more specific, HBC reached the highest number in total assets at approximately 17,000 billion Vietnam dong, mainly in the short-term investment among 3 years. However, there was a slight decrease in the long-term debts. That after a year, the short-term assets of HBC were significantly dropped by almost 100% of that of the previous figure. Besides, HBC is still well managed in increasing its equity stock value and reduce the debts. We will come to a more detailed analysis by comparing to its components, CTD, in terms of managing the balance sheet. As can be seen from the chart, HBC increased while CTD decreased in the amount of the short-term investment. This could be explained by the fact that the inventory rate of the HBC has increased rapidly by nearly 36% from 2018 to 2020. Otherwise, although CTD has a higher percentage of the current excess, HBC has more potential than CTD in generating the short-term investment. In terms of the non-current investment, overall, HBC decreased gradually. The non-current excess of HBC dropped by almost 3% due to the fact that it is currently working its way to reduce its non-current for a significant decline in the intangible assets. So it can be said that HBC still has more potential than CTD, thanks to the high figure of the long-term prospects. Talking about the current liabilities, the proportion of HBC after 3 years has declined by 0.64%, while CTD fluctuated in the percentage of the short-term liability throughout the years. Otherwise, HBC did more efficiently than CTD in controlling its debt. The long-term liabilities witnessed the large gap between 2 firms over the period of 3 years. We all know about the debt lawsuit between HBC and FLC at the end of the year 2018, which made this firm have a hooked debt. Unlike the HBC, most of the CTD's debts come from the long-term provisions, which made its non-current liabilities extremely small compared to that of HBC. Thus, CTD is less risky than HBC in the long-term debts for investor. Finally, Both firms have the same tendency of gradual increase in the amount of the stockholder equity. This is due to the rise in the share issuance of HBC, as well as the investment and fund the development of CGD throughout the period. Meanwhile, the proportion of HBC grew marginally by over 80%. And at the end of the period, the owner equity rate of CGD recorded double that of HBC. Hence, it can be said that CGD is better than HBC in the controlling the value of owner equity. And that is the end of my part. Young will introduce to you about the income statements later.
So now we come to the income statement. So it includes total revenue and cost of goods sold, total expenses, non-operating gain and losses, and earnings per share (EPS). As you can see, total revenue, cost of goods sold, and total expenses had the same pattern with slight increase in 2019 and a significant decrease in 2020. Cost of goods sold price was unique in 2019 and it increased stronger compared with the increase in the total revenue in the same year. Because cost of goods sold had a major effect on the total expenses, therefore total expenses also increased more than the expected in compared with the total revenue in order to reflect this cost of goods sold unit change. So non-operating gain or losses was negative for 3 years period. However, the figure was improving during the same time, with the end number in the 2020 was just at half value with the end number in the 2019. So with the earnings per common share (EPS), a unit pattern could be observed here that it dropped significantly in 2019 and it became worse in 2020 because it dropped with 80% of its previous figures. So the reason contributing to this excessive drop was that urban construction issued more share in the 2019 and the pandemic had made the construction picture become more gloomy as well as lower demand for the construction. So in conclusion, 2020 was a difficult year for urban construction and its business profit and earnings per common share dropped significantly. So now we come to the comparison between HBC and CGD. So first with total revenue, we can see that Kotecon has higher revenue than urban. However, a downward trend could be observed in both companies and also due to a slightly increase in 2019, it make the gap between two companies become smaller. So the reason is that with Kotecon equals restructuring its structure during this time, and also the COVID-19 pandemic lowered the demand, which directly affect the total revenue of both companies. So in conclusion, urban is more potential and currently is better than Kotecon in construction market. Next, we come to the cost of goods sold. So a significant point here is that cost of goods sold proportion with total revenue increased in the 3 years period. However, urban managed to maintain cost of goods sold proportion lower than Kotecon in comparison. So the reason here was that the fluctuation in material price, the restriction, and the pandemic policy has directly affected the cost of goods sold, and therefore cost of goods sold reduced the profit margin significantly in both companies. So in the total expense, we can see that urban construction total expense was slightly higher than Kotecon ones. So the reason here is that although urban saw a drop in demand, a lower sale, however, it maintained high administrative and selling costs as well as high other expense. Therefore, its total expense even in 2020 even managed to exceed its total revenue. Therefore, urban construction must focus on cost controlling and they must be cautious when it comes to cost. So next is non-operating gain and losses. So at first we can see that Kotecon was doing better than urban construction because it was having a positive non-operating gain during the year, while urban construction experienced non-operating losses. However, urban construction was improving during this time, while Kotecon were witnessing a decrease in its non-operating gain. So although urban construction was improving, Kotecon was still better at urban construction in this aspect. So lastly, we will come to the earnings per share. So at on, we can see that Kotecon has Protecon earning per share has completely outweighed the earning per share in Huabin Construction. And the trend is that a downward trend can be observed at both companies. With Protecon, the earning per share reduced 50% in both 2019 and 2020, while with Huabin Construction, its earning per share dropped 40% and 80% in 2019 and 2020, respectively. The reason here is that the pandemic had both affected the company with directly lower demand, also had made the construction market picture more gloomy, and also due to in urban construction, especially it is more share with directly diluted its earning per share. Therefore, it led to the lowest earning per share in 2020.
Hello, my name is Tan Hee, and we'll continue with the ratio analysis. So first, we'll move the liquidity ratio. About the current ratio, Huabin has slightly increased its debt payment ability from 1.1 to 1.7 to 27, compared to a Koticon ratio increased from 1.73 to 2.24. So Koticon's current ratio was higher than the Huabin ratio, so its debt payment ability was more favorable. So about the quick ratio, Huabin quick ratio remained about 1 throughout 3 years, so it's ensured the ability to pay short-term obligations. Meanwhile, the Koticon quick ratio increased from 1.57 to 1.98. However, this ratio was too high, causing the capital stagnation. Move to the last ratio, about the cash ratio. They show different trends from the two ratio above. In 2019, Huabin was quick cash ratio was higher than Koticon's, which peaked at 0.05. It can be explained that in 2019, Huabin did not invest much when the short-term investment dropped by 17%. Move to 2020, Koticon's surpassed the Huabin ratio in cash ratio with 0.04. It can be seen that Huabin had a better debt settlement when the short-term debt plumped by 25%. So move to efficiency ratio. With the inventory turnover, Huabin dropped by over a half throughout 3 years. So Huabin struggled to manage inventory turnover as it faced the huge effect from the COVID-19 pandemic. However, the Koticon has showed the upward trends while their ratio below 0. So this showed that the Koticons have made effort to maximize inventory during the period. What to the receivable turnover, the Huabin ratio slightly decreased by 0.03 in 2019 and then peaked at 0.95 in 2020. Then Koticon's ratio showed upward trends with improvement by 0.16. So the Huabin has performed more effectively than Koticons in collecting receivable on time. About the total asset turnover, again, both firms show the downward trends, and the Koticons remain higher than Huabin. So it can explain that in 2020, more than 30% of company projects postponed and delayed. So it has a significant drop in sales of both firms. So move to the fixed assets turnover. So Huabin ratio dropped from 12.88 to 9.67. Also, Koticon dropped from 38.4 to 24.11. So Koticon is more effective than Huabin in generating money for the organizations using fixed asset. Move to the long-term solvency ratio. But the total debt ratio, Huabin decreased from 0.82 to 0.73, was higher than Huabin with 0.52 to 0.41. So it can explain that the majority of Huabin's assets were financed by debt, so the total debt of Huabin was higher. Move to the debt equity ratio. Huabin ratios dropped by 1.69 throughout 3 years. Meanwhile, the Koticon's ratio dropped by 0.42. So when the sale drops suddenly, Harbin has a great chance of default than Kotekons. Moved to the equity multipliers, Harbin decreased by 1.69 because it had a low equity due to debt financing, and Kotekons dropped by 0.42 because it has a loss of equity due to equity financing. The different structure left companies with significant difference in equity multipliers. So that was the end of my presentations. Next, I will continue with her part.
Next, I will talk about the profitability ratio. First is the profit margin. In general, both companies are on a 3-year declining trend. The greatest decline of CTD was in 2019 and HBC was in 2020. The reason for this issue is the rise in cost of goods sold in both firms, although CTD has a lower cost of goods sold than HBC. Large amount of interest expense and unsuitable operating costs left HBC a low profit margin compared to CTD. This is a negative signal since if the ratio is closer to 0, it's implied that the company is having difficulty controlling expense and did not generate good sales. Next is return on assets. In general, both corporations have had the same downward trend throughout the years. CTD has the highest figure with 8.98% in 2018. However, it dropped by more than half in 2019. On the other hand, HBC has small decline from 2018 to 2019 before reduced by 80% in 2020. Overall, the lower percentage of return assets of HBC compared with CTD reveal that the companies perhaps have overinvested in assets that lead to a failure in generating revenue growth. Finally, is return of equity. From 2018 to 2020, both firms sink dramatically. In 2018, HBC ratio remained higher than CTD with 21.22% compared to 18.07%. But from 2019 to 2020, HBC dropped tremendously, nearly 19% to only 2.02% in 2020, lower than its rivals. This is the alarming sign for both companies since the lower return of equity, the more inefficient the company's capital is. In conclusion, the company activity, which were illustrated on the income statement, HBC was doing better than CTD. However, with the balance sheet, CTD was possessing more resources as well as power compared to HBC, and that CTD's value was still higher than HBC. HBC did work effectively in controlling its assets, reducing the liabilities, and maintaining the value of stock equity, even when the company has faced some financial problem with FLC and the negative effect of COVID-19 pandemic during the period. One of the most significant differences between two companies is that they are leveraged in different ways. HBC was referred debt to finance its operation, while CTD likely used its own equity with different leverage. It is clear that some compare ratio as not reliable or valid. Recommendation for HBC is the firm should focus more on control its assets, liabilities on the balance sheet from the perspective of income statement. HBC current business activities was doing better than its counterparts. Furthermore, cost controlling and refrain from stock diluting also should be better for HBC business activities. So this is the end of our presentation. Here is the references slide, and thank you for listening.